Good afternoon. Getting right down to business here. We are doing it live, doing more at 4 weekday afternoons, right after Guy Benson here on 790 KBC, and just before the 790 KBC News Blitz with Randy Wang at 5. Mottek On Money, live on the air, 790 KBC, streaming live online worldwide at kbc.com. And the on-demand Mottek On Money podcast, kbc.com, Apple, iTunes, YouTube, and all of your favorite podcast platforms. Another wild ride today on Wall Street. Stocks finishing lower, extending this week's rough week to a second day, despite the president's appearing to take a step back from his promise to impose 50% tariffs on Canadian steel and aluminum imports, up from the 25% previously announced. The Dow came in for a closing loss today of nearly 500 points, down 478. The S&P 500 down 42, settling at 5,572, and the Nasdaq taking another hit, but not quite so bad as it yesterday, down 32 points at 17,436. Another volatile session for the stock market today. The day started deep in the red after the president placed additional tariffs on steel and aluminum imported from Canada. The sharp sell-off briefly put the S&P 500 on pace for a correction territory. The Wall Street Journal then reported that Ukraine had agreed to a 30-day ceasefire contingent on Russia's participation. And then the back and forth on the tariffs played out with the Premier of Ontario in Canada, Doug Ford, and the U.S. Commerce Secretary Letnick issuing a statement saying they agreed to participate in a discussion about renewing the U.S.-Mexico-Canada trade agreement ahead of the Trump administration's April 2nd reciprocal tariff deadline. The S&P 500 and Nasdaq briefly bounced into positive territory on that news, but did not sustain the rally and moved lower at the opening bell. The president today opened the door to tariffs on Canadian steel and aluminum of less than 50%, just hours after saying he'd impose such tariffs in retaliation for new trade rules put in place by the province of Ontario in Canada. I'll discuss the latest head-spinning back and forth on tariffs and the impact on the economy, trade, and the markets this hour with Stephen CHEUNG, the president and CEO of the Los Angeles County Economic Development Corporation. The LAEDC is also president of World Trade Center Los Angeles. We'll also be joined later this hour by AXEL MERK, the president and chief investment officer at MERK Investments, which includes the VanEck MERK Gold ETF, also gold and currency expert, author of Sustainable Wealth. We did see a gold move sharply higher today as the dollar slipped overseas against other major currencies. Right now on Your Money, the markets and the economy and the whole works, let's bring in Paul DIETRICH now, who is now the chief investment strategist at Wedbush Securities, headquartered in the heart of downtown Los Angeles. Paul DIETRICH, thank you very much for taking the call on this busy day here, and congratulations on your big news, becoming the chief investment strategist at Wedbush Securities here in Los Angeles.
Thank you, Frank.
Wonderful to have you with us, Paul. It's been a while since we've chatted behind live microphones, so take it from the top and give us your impression of the sell-off we've seen this week and your impressions of the market overall.
I try to keep my focus not on political events or geopolitical events and trying to look at the economy as it is. And what we have been seeing has been a steady weakening of the economy. We're seeing jobs, private sector jobs have been going down for months, and it's been held up by government, the increase in government jobs because of all the stimulus money last year. But that's gone, and it's unlikely to be, returned by any Republicans. And if you looked at the last jobs numbers, it didn't include the 80,000 plus people that have been let go in the federal government. That will come next month, and I expect that jobs report to be not very good. And then you look at retail spending, and you look at all of the earnings projections by Walmart, Costco, McDonald's, you name it, and they're all predicting that it's going to be kind of deep cuts in retail spending. And when you get unemployment going up, you get retail spending going down, and you get the Federal Reserve in Atlanta that's now projecting that we're going to have negative GDP growth in the first quarter. and you get two consecutive quarters of GDP growth, and that's pretty much the definition of a recession. And then on top of that, if you have the tariffs, which are, tariffs are a tax, they're basically a sales tax on imported goods. It has always increased inflation if they stay there for any length of time. And so, inflation is probably going to go up. We're going into a recession, and, it doesn't look good for the future.
Paul DIETRICH is with us live now, the chief investment strategist at Wedbush Securities in downtown Los Angeles, with a unvarnished assessment here of things on the economy and the markets. The Atlanta Fed, at least in recent years, had been rather optimistic with their projections, but to come out with that report recently signaling an economic downturn, that's interesting. The Atlanta Fed, by the way, headed up by Raphael Bostic, a former USC professor. We used to speak with him on the air frequently during the financial crisis back in those days. I believe he was with the Saul Price School there at USC, now heading up the Atlanta Fed for many years. So that's very interesting. What is your assessment here of how this recession might play out? Of course, President Trump was asked about this with Maria Bartiromo over the weekend. He said he can't rule out a recession, but if we were to get one, how severe do you think it might be?
Well, I think it's going to be a fairly significant recession, but I also think that the stock market could actually go down much lower than people are expecting. And the reason for that is, and several economists have done history of this, is that when you have a severely overvalued stock market, like we do right now, this stock market, in terms of every measure of valuation, is the most overvalued stock market that we've ever seen. Even in the Depression, the highest one before this was the 2001-2002, .com recession, and we've now exceeded that. And whenever you have an overvalued market and you have a recession, the stock market in an overvalued state goes down further than we would expect for previous recessions. And you look at the 2001-2002 recession. Basically, the S&P 500 lost 49% peak to trough. The same, the NASDAQ went down 77% peak to bottom. And then you go to 2008 and 2009, and the S&P was down, 57% during that period of time. Well, that's what happened in the last two major recessions, and I think that because we're in an overvalued stock market, we could see similar sort of losses in the stock market. And I don't think Wall Street and most investors are preparing for this.
On the air live with Paul DIETRICH at Wedbush Securities, chief investment strategist, and certainly the Mag 7 led by NVIDIA led this rally, and now apparently leading the decline here, with NVIDIA bouncing back only slightly today at 108 and change, down up nearly $2 today after that washout yesterday. We're coming off today, coming off the worst one-day loss so far in 2025 yesterday, and the Dow was down nearly 500 points again today. The NASDAQ down just 32. The S&P 500 down 42 points today. What about NVIDIA and the rest of the Mag 7 or Mag 8, depending on who you count in there?
Well, look, those companies are spectacular companies. They're all profitable. They're all doing things that, are basically wanted and needed by consumers. But what people forget is that during a recession, if we have a recession, and today Larry Summers came out and said he sees a recession coming. You're seeing more and more people, because of that. I think that Atlanta Fed projection of negative GDP. coming out and believing that there's a high probability that we're going into a recession, that the good goes down with the bad. The average drop of the S&P 500 over the last 100 years in a recession has been 36%. And as I said, in 2001 and 2, it was 49%. In 2008, it was 57% for the S&P. What is it going to be this time? But it's going to be a significant drop, and the good goes down with the bad. People forget that in the dot-com recession, basically Microsoft, which was a very profitable company at that time, went down 68%, Apple was down 72%, and Amazon was down 95.5% during that, 92.5% during that recession. And IBM, which was the most profitable and the biggest, tech company in the world at that time, for kids who didn't live during that period, it was the NVIDIA of its period. It was down 53%. Now, all of those companies are now back, and they've done very, very well. But people forget, if you lose 50% of the value of your stock, you have to go up 100% to get back to even again. So we're going to go through some rough times.
On the air live with Paul DIETRICH, who is the chief investment strategist at Wedbush Securities. Among the high flyers, Tesla has had its wings clipped in recent months now, higher today by more than $8, back to $230 and change. It looks like the stock rallied today after President Trump made good on his vow to buy a Tesla in support of Elon Musk. They hang out a lot, of course, and Elon Musk is involved in the DOGE effort, the Department of Government Efficiency. So Tesla getting a boost on this. What about Tesla here and the other names more specifically? Apple continued its slide, down more than $6 here at $220 and change, and the list goes on.
Well, Tesla is getting hit by a lot of political stuff, and my experience is when stocks are at the effect of some political or geopolitical event, that it's over quite quickly, and it can recover. With Apple, I look at what Warren Buffett has been doing, and Warren Buffett has been, it's literally his favorite stock, I think. He loves Apple, but he sold, large portions of it. And then when you ask him on several occasions, he's publicly said, that he just thinks it's overvalued, as all the tech stocks are in the right now. And he's put together a $334 billion cash hoard, and he's just sitting there with a lot of cash, and I expect he's going to buy back Apple when it goes down significantly in the recession, and just pocket the change. And that's what your grandmother told you to do when you were a little child, buy low and sell high. And that's what he's doing.
On the air live with Paul DIETRICH at Wedbush Securities. And in all this today, we saw gold rebound in a big way, back above 2,900. Of course, gold recently hit an all-time high. We do talk about gold, so-called analog gold, as well as so-called digital gold. We talked to the biggest fans of crypto here, as well as the harshest critics. And if memory serves me right, you were one of the harshest crypto critics here. So give us your view here on the good old gold and so-called digital gold here.
Yeah, I would never call crypto digital gold. I have in my portfolios, I keep almost a 25% in my portfolios of gold. And in a recession, gold will continue to go up. It is a great investment. And there is some, because of the trade war problems with this administration. You can see central banks trying to buy more gold. That's one of the reasons why it's going up, and for people to get out of the dollar. And so gold is going to continue to be a great investment during a recession. Crypto is not, and it's not digital gold because it's backed really by nothing, some zeros and ones in their algorithms, and that's the underlying value of crypto. And so I wouldn't equate the two.
All right. What do you see ahead for the Federal Reserve? They're having their big meeting in about a week or so, right? And then President Trump focusing on the longer end of the curve here with the yield in the 10-year note now at 4.28%. We have seen the mortgage rates come down recently. What do you see ahead on the rate front?
Well, because of the fear, and it's a real fear, of inflation going up because of these tariffs, and we just know from history that that's going to happen, and so the Fed is, I think, going to hold tight for the foreseeable future. If we go into a recession, and we may not know until the second quarter, if we're seeing in the second quarter GDP growth being negative in 2 consecutive quarters, then I think you're going to see the Federal Reserve start cutting rates, which would be a good thing. But that's what you do during recessions. But I think they're going to, for the short term, they're going to hold, and for the long term, they'll cut if we go into a recession.
All right. On the energy front, mercifully, we've seen the price of oil dip to the mid-60s now, and that's certainly got to help with inflation, although our gas prices here in L.A. Seem to be stubbornly high despite the recent dramatic plunge in oil prices from around $80 a barrel to the mid-60s here now. What do you see ahead on the energy front?
Well, again, if we have a recession, energy usually goes down. But one of the things, and this is something that is a question mark going forward, is that all of the massive hundreds of billions of dollars in investments that have gone into server farms and into the backbone of artificial intelligence and AI, which you can see. I live right outside of Washington, D.C., and I mean, one seems to be going up every day, these massive data centers. And so they're already funded. They're going to go forward even if there's a recession because, the money's already been spent or is being spent. And the amount of energy that is needed to drive all these things everywhere in the country is enormous. And that's why I think the best play on this is not to buy oil companies, or, they're okay, but the best play is to buy utilities, because utilities, they're the ones who are providing the electricity to these data centers. And because they're utilities, and they're usually regulated by state government, they can take their energy source from anywhere. They could take it from nuclear, they could take it from wind, they could take it from solar, or they can take it from oil, natural gas, or coal. And by law, they get to mark it up about 20-25%, depending on the state. So it's kind of one of the best ways to play the energy demand. And you can see utilities have done very well lately.
All right. One last question here, the big one. We take a moment to tackle this one. Any ports in a storm here, given what you've laid out, and any specific places where you are putting money now and/or taking it off the table?
Well, yeah, I think that there's there is the possibility and a good possibility for a recession. So, and I think with all the people, Goldman Sachs have been saying this, all of the analysts have been upping their percentage of what they're betting will have a recession or not. And so it's you have to take this seriously, and you have to think about it. Now, whether we'll have it or not, that's still a question. But I'm preparing, and in preparing, I just don't want to lose a lot of my clients' money, and so I have a lot of money in cash, treasuries, gold, utilities, and those are the most conservative and the best way at the moment to protect your investments. However, if you have to be in stocks, you have to realize that, a recession is what we economists call a business cycle change. It means that everything that you know for the last 10 years is going to change, and there's going to be a whole new set of stocks that are going to be outperforming or underperforming. And most people don't believe it's going to be tech. And so, but people have been investing heavily in technology. And so if you look at the last two recessions and you look at which stocks did the best, basically it's consumer durables, consumer staples, it's healthcare, it's Costco, Walmart, McDonald's, the less expensive retailers. Those have been AutoZone of the companies that when people start fixing their own cars rather than buying a new car. These are the stocks that will do best in a severe market downturn, which I think, given the last few days, you just can't discount that that's going to happen.
Paul, thank you very much for joining us live here for your thoughtful analysis. As always, look forward to many more conversations as we track all this on a daily basis. Paul DIETRICH, now Chief Investment Strategist at Wedbush Securities, headquartered right here in the heart of downtown Los Angeles. Paul, thank you very much for taking the call here this afternoon.
Thank you.
And out to the freeways we go now, 790 KABC. Mottek On Money continues, 790 KABC. Another rough day for stocks. The Dow plunging nearly 500 points. The S&P 500 down 42. The NASDAQ down another 32 points, coming off the worst one-day drop we've seen so far this year yesterday. Cryptos continue the wild ride. Bitcoin down about 460 now, back to 82,646. Ethereum down 13 at 1,924. And Doge at the moment at 16 cents. We'll continue our coverage on the markets, the economy, tariffs, gold, crypto, the whole works coming up here in just a moment. But first, the latest news here in 790 KABC. Mottek On Money continues, 790 KABC. Good afternoon. Another whipsaw day for the stock market and more reaction seen in the financial markets. Gold roaring back today above $2,900 an ounce. Silver is back above $33 an ounce. We did see the Dow pull back 478 points today, settling at 41,433. The S&P 500 down 42 at 5,572. The NASDAQ sliding 32 points, 17,436. Looks like the dollar slipped overseas. We're at 109 versus the euro now. Let's bring in AXEL MERK, now the president and chief investment officer at MERK Investments, which includes the VanEck MERK Gold ETF, the ticker symbol OUNZ. He's also a gold and ETF expert and author of the book Sustainable Wealth. AXEL MERK, thank you very much for taking the call here this afternoon.
Great to be with you.
Wonderful to have you with us here, and certainly now with recession talk very much in play here. Give us your impressions of what's happening.
Well, I think I mentioned previously on the program, the best investment advice for this year may well be to buy a lot of popcorn and enjoy it. It's difficult to keep up with everything that's happening. The markets are obviously nervous, in part because executives are withholding decisions. You're not going to make decisions if there's so much uncertainty out there. And I heard one report out of Europe, one out of Canada, that the tariffs, some of the tariffs that are planned are actually worse for the U.S. than they're for the respective countries. So I don't know whether that means that these countries are getting used to them, resigning themselves to the fact that there will be the case. And of course, we know that there will be U-turns, right? I mean, and we've had some today, and the markets don't like all of that. But keep in mind, of course, this happens all in the backdrop of a very expensive stock market. And whether or not we will have a recession in the near term remains to be seen. For the time being, though, many investors are jittery, yes.
Yesterday, we saw that big hit for the stock market. Gold also pulled back but rebounded today. What do you see happening with gold in all of this? And for that matter, what do you see happening with the dollar, which appears to have weakened again today?
Well, on gold, historically, when we have a big sell-off, in the initial wave, gold can be dragged down. It's a deleveraging, the risk-off environment. And if the recession fears are real, if the economy is weaker than previously priced in, then what historically often happens is that traditional equities perform mediocre to poorly, depending on how bad the economy is going to be. But an increasing number of investors are looking for diversification, and then gold really takes a bid. Whether you can draw that conclusion from a few days of volatility is, of course, way too early. But that's kind of that many gold investors believe in the diversification for that sort of scenario. And with regard to the dollar, what's very noteworthy is that the dollar hasn't acted like a quote-unquote safe haven. And the question is whether that will persist, whether that is due to the tariffs and the weaponization of the dollar. It's difficult to say, but it is quite noteworthy that the dollar has been weakening. Part of that is, of course, that these huge spending packages have been signaled at least. They aren't confirmed yet. They still have to make it to parliaments and so forth. But when Europe spends like crazy, then there might be investment opportunities in Europe, and it's part of what we're seeing, a reallocation of assets from the U.S. to other countries.
Something else that appears to be moving the market, the report that originally appeared in the Wall Street Journal that Ukraine had agreed to a 30-day ceasefire contingent on Russia's participation. We see the German markets hitting record highs recently. Tell us about what's happening on that front.
Well, the record markets may well be on the Mr. Merz is his name, the presumed incoming chancellor in Germany. He used the words, he'll do whatever it takes, obviously made famous by the previous ECB central bank president Draghi, on the spending side to make sure that Germany will rearm. And in order to get that done, they need to get an institutional change done. In order to get that done and get other parties on board, he needs to promise hundreds of billions of infrastructure spending to future coalition partners and whatnot. So that is the primary reason I think the German market is up. Ukraine, of course, we are back to where we probably could have been without all this much drama. The ball is in Russia's court, whether they'll agree to a ceasefire. Personally, I'm not so convinced that Russia is interested in peace. But again, if it wasn't all that serious, I'd get a lot of popcorn and just sit back and watch.
All right, looks like the popcorn stocks will have to pull those up here because I think you're absolutely right about that. So we're in for a very interesting ride here with a lot of back and forth and a lot of news on a minute-by-minute basis here that we're following as best as possible. Axel, well, thank you very much for taking the call. As always, I wish we had more time, but I know we'll be following you on social media, on X, formerly known as Twitter, at AXEL MERK. And thank you very much for joining us live here. That is Axel MERK, the President and Chief Investment Officer at MERK Investments, which includes the VanEck MERK Gold ETF. The ticker symbol is OUNZ. Axel MERK, also a gold and currency expert and author of the book Sustainable Wealth, and fortunately a frequent contributor to this program over many years. Axel, thank you again very much for joining us live here today.
My pleasure.
And right out to the freeways now, here on 790 KABC. Mottek On Money continues here on 790 KABC. The back and forth on the tariffs being closely watched not only in the financial markets but also on Main Street. We did see a wild ride on Wall Street today after President Trump placed additional tariffs on steel and aluminum imports from Canada. The president later opened the door to tariffs on Canadian steel and aluminum of less than 50%, just hours after saying he'd impose such tariffs in retaliation for new trade rules put in place by the Canadian province of Ontario. We're watching what's happening here very, very closely, and joining us live now, a giant on the local business scene, and that is Stephen CHEUNG, the president and CEO of the Los Angeles County Economic Development Corporation, the LAEDC, also president of the World Trade Center, Los Angeles. Stephen CHEUNG, thank you very much for taking the call here.
Thanks for having me back.
Give us your reaction to the latest back and forth on tariffs and the concerns now of the economic impact of all this.
Well, it's not unexpected, this back and forth. It's been what we've been seeing over the last a couple of months already, but it's definitely not helping when it comes to consumers and also business certainty. What we're looking at is, as we're looking at these fluctuations of whether there's going to be a tariff or not, it's causing some confidence issue when it comes to the future of our economy. And we can only wait and see what's going to happen to see whether those tariffs will actually get fully implemented. And if so, then we do have to really carefully look at some of the numbers which we have been tracking.
Tell us more about that as things stand now. I know things are changing minute by minute, and you just had your big economic forecast event recently. But what is your best calculation now on how the tariffs that are on the table will be impacting the Southern California economy?
Well, we have to look at our economy as a whole and our industries, right? One of the things that you're going to note is that manufacturing is still a huge sector here in the Los Angeles region and throughout California. In fact, usually every single year, manufacturing goods make up a vast majority of California exports. That's worth about $155 billion. And California is the second largest state exporter of goods of any place in the U.S. And if there are going to be any retaliatory tariffs, this is going to impact the way that we're going to be able to export our products, whether it's textile, whether it's wine, whether it's our agriculture or any of the manufactured products here. So by having less ability for us to export and also the increased price of importing, this will potentially impact the jobs that are going to be created here in this entire region. Our economic forecast 2 weeks ago looked at the forecast for this year, and we're not seeing a huge growth projection when it comes to GDP. In fact, we're starting to see trends of upward unemployment numbers going up, not by a huge number, but given the challenges we face, any increase is definitely not welcomed.
And now the word, the recession is starting to be bandied about, and at the same time, of course, a lot of focus of attention on imported items that'll be needed, imported products that'll be needed for the recovery here of Los Angeles in the firestorm area. You're leading the recovery together for LA with the LAEDC at the forefront. Give us an update on this important effort and how things with these tariffs might impact the recovery and the cost of the recovery.
Yeah, we issued a new report in partnership with the Southern California Leadership Council, and this report have quantified, we know that, for example, there are 16,244 structures that were destroyed in the Palisades and Eaton fires combined together. And within the two regions, within the burn zones, there are about 1,863 businesses located within those zones, employing 9,610 workers. Last year, their sales before the fires were about $1.4 billion in total volume, right? So these are the potential impact we're going to see moving forward. In order for us to recover, you can imagine of the 16,000 plus structures that were destroyed, we're going to need to rebuild. And in order for us to rebuild, we're going to need lumber, we're going to need steel. And both of those items are on the tariff list. For those who are not familiar, a lot of the lumber for building actually comes from Canada. In fact, a third of the softwood lumber used in U.S. is imported directly from Canada every year. So this increase in cost is going to eat into our ability to really quickly recover, and especially as we're thinking through additional constructions that are necessary for us to meet the housing needs for this entire region. This is now adding pressure to the entire system. So yeah, the tariffs will definitely have a huge impact, and how large, it basically depends on what the retaliation is going to look like, how long the tariffs will be instituted for, and basically whether there are going to be changes into our local economies in terms of how we source these materials.
And certainly with so many businesses destroyed and the livelihoods of many people in those areas also destroyed. Tell us about the resources that you've gathered there, part of Together for LA, and any updates on the resources available for businesses and those impacted by the firestorm.
Yes. So Together for LA is an initiative that was created during COVID to really help small businesses learn how to navigate the resources that might be available to them, because sometimes a lot of our small businesses are inundated with these news about things that are coming up, but they don't know how to apply for it. So togetherforla.org, we created this website to gather the information. This is a partnership between LA EDC, LA Area Chamber of Commerce, BizFed, Dr. Lucy Jones Center, LISC LA, Department of Economic Opportunity from LA County, LA City's Economic and Workforce Development Department, and many other partners. So the resources and information are there. And what we saw was that there are a number of different funds now available. One of them is actually the county and the city's combined fund for business disruption. So that fund is available for application online through our website Together for LA, and they can go directly to the county website as well to apply for this. The grant is up to $25,000 per business. So and we're seeing additional investments. 2 weeks ago during our economic forecast, Governor Newsom stopped by the economic forecast at LADC and announced that he's going to be investing an additional $10 million into this small business disruption fund to really assist the local community to be able to recover. So we're going to see more and more investments to help our small businesses go through this long-term recovery process.
Stephen Cheung, thank you very much for that thorough update. As always, we'll keep an open line to you. That is Stephen Cheung, the president and CEO of the Los Angeles County Economic Development Corporation, the LAEDC, as well as president of World Trade Center Los Angeles, getting set for their big Select LA Summit coming up in about a week or so. Thank you very much for joining us live here on Mottek On Money on 790 KBC.
Hi, I'm Joe Salciha, host of the Stacking Benjamin Show. We are diving into what should be in your little emergency go bag. What goes into your financial go bag?
Passport, driver's license, social security card.
Cash, credit cards, my wallet.
The most important thing, your master password.
OG just gave us the guns. That's all he needs.
Meaning the bicep.
Come and get them. You never knew personal finance could be this fun. What's a big can of Colt 45 cost?
Stackers Anonymous. Is that about $3.50?
That's what
Dr. Pepper.
Go bag. Stacking Benjamins. Follow and listen on your favorite platform.